Welcome to another ASX webinar with me, Anastasia Anagnostakos, National Business Development Manager for ASX Investment Products. 2020 has seen turbulent markets post the COVID market crash, and never has the value versus growth stock picking argument been more alive. Our special guest today is one that I'm particularly excited about, as this week we have welcomed their new active ETF, MAET, to the exchange. Munro Partners are one of the few active managers pursuing a growth-based approach to picking stocks with an outstanding track record to prove it. From Munro Partners, I have Nick Griffin, CIO and founding partner. Nick is responsible for the investment management of Munro's key investment funds and the formulation and implementation of the investment process. He's also been managing long-short equity mandates for over 12 years and has a career spanning over 20 years in financial markets across the globe. Nick, such a pleasure to host you on this webinar today.
Thanks for having me, Anastasia.
Excellent. So, Nick, do you want to take it off by telling us a little bit about Munro and what it is you do at Munro that sets you apart from other fund managers?
And thanks very much for having us today on the show. So Munro Partners was a business formed in 2016 here in Melbourne, Australia. And maybe it's probably best to explain what a Munro is, first of all. And a Munro is effectively mountains in Scotland over 3,000 feet. There's actually 286 of them. And your goal is to go and climb them all. And I spent a lot of my career in Scotland, and the reason why we named Munro after the Munro Partners, after the Munros, is we sort of a bit of a homage to Scottish. We used to always look at the way they sat in Edinburgh and took very long-term views of the world and made very, very good returns. And in many cases, their businesses are over 100 years old. And so when we set up the business in July 2016, our goal was to be Australia's global growth investor. So we wanted to sit in Melbourne, Australia, and take really long-term views about global growth stocks. We set that up with the Munro Global Growth Fund, which is a flagship product, which is what the quoted product that you spoke about earlier is going to track, or the active ETF is going to track. And that fund's done 17% per annum in the 4 years that we've been running. And we run roughly 4 billion in assets under management. And so that's really the Munro story to today, and super excited to have it listed on the exchange today also.
Excellent. So there's been much said around, like as I mentioned before, growth versus value investing. And with the bounce back in equity markets this year, there's been a lot of market commentary about high valuations still seen in equity markets. There are some managers out there that believe it all comes down to valuation, taking a bottom-up approach and finding those undervalued or cheaper stocks. But valuations are important to any portfolio, as we know. What approach do you take first? You take the top down or the bottom up, and just take us through your philosophy.
Yeah, so our philosophy, and I'll just skip forward a few slides here. So I'm on slide 5. Look, our philosophy is equity markets is a game of very few winners and lots of losers. Our business is a partnership here based in Melbourne, Australia, and our goal is to basically go and try and meet and find these very few winners of companies. So there's a picture of the team here. We're doing 500 meetings per annum. We identify these structural areas of interest, and we really try to drill down on these few great growth companies that you're looking for. And so that philosophy is sort of more summarized on this slide, on slide 7. So if you think about what your goal is in equity markets, your goal is to find these very few winners. And so our philosophy has some fairly unashamedly simplistic statements around it, which is that earnings growth drives stock prices. So we generally find that companies that make more money every year, we generally find their share price goes up. We also think that sustained earnings growth is worth more than cyclical earnings growth, and the market always misprices growth and sustainability. So we're showing you 2 pictures here. One is the picture of MasterCard, and that's the share price over the last 5 years or the last 12 years in black, and the blue line is its 12-month forward rolling earnings expectations. And on the right-hand side is Bank of America. That's the share price of its 12-month forward rolling earnings expectations. And all we're saying is your growth manager is that we don't have a lot of value to add on the Bank of America situation. It relies on the economy, it relies on interest rates, it relies on a whole bunch of variables that we have a view, but our view is as good as anyone else's. The MasterCard situation is different. It's benefiting from the shift from physical to digital cash. People in Australia would understand this with companies like Afterpay. And so from that point of view, it's a structural shift. And so the earnings don't mean revert, they structurally accelerate. And so these are the opportunities we're looking for time and time again when we look around the world. And then the last thing I'd just say on this, before I talk about the valuation side of it, and is the problem is that everyone really struggles with is there's actually only a few of these companies around. So equity markets is a game of very few winners and lots of losers. Your goal is to find those very few winners. The Munro Global Growth Fund is designed to find those very few winners outside of Australia. So let's be clear about this. If equities is a game of very few winners and lots of losers, those few winners are unlikely to all be in Australia. A vast majority of them will be outside of Australia. And so when you think about those very few winners, here's just a simple slide that we show to get people to think about what we're trying to do here. Is this was a study done by a guy called Henrik Bessenbinder. He said, do stocks outperform treasury bills? And so what he did is he said, what would happen if you bought and held every company that's ever listed on the US stock market over the last 90 years? And it ends up actually being 25,300 companies. And if you buy and hold every single one, more than 60% of them, 14,000 of them go to zero. So most stocks go to zero. The next 8,000 only make what the other 14,000 lose. And you end up with just 1,000 companies, so less than 5% of all observations that generate the entire value. Out of those 1,000 companies, the top 50 make up nearly 50% of the values. That's 50 companies out of 25,000 make up 50% of the value of the US stock market over the last 90 years. It would be exactly the same in Australia. It will be exactly the same in other countries. We plotted these companies for you here. And if you look at them on the right, they're all driven by strong structural growth tendencies. And so from that point of view, there's a lot of emphasis on the digitalization winners at the moment, but that's actually just the big structural change of our lifetime. If we go back, there's the structural growth of software, the structural growth of big box retailing with Walmart and Home Depot, the structural growth of McDonald's and quick service restaurants. And so our goal as your global growth investor is to occupy the top left-hand corner of this slide, is to work out what's coming next. And so I'm going to finally answer your valuation question. I apologize here. But the reality is if you're going to find these very few winners, you're going to have to take a longer term view. You're going to have to look at what the potential value of a company could be, not what it's trading at today. And our job, as I said, as your growth manager, is to occupy that top left-hand corner and see what's coming next. Is it Netflix? Is it Salesforce? Is it Tesla? Is it a healthcare company? Etc. And so that's where we sit in the growth value equation, and that's what we're trying to solve for you, and that's why we think we make up a good part of your portfolio.
So I'm going to jump in here and ask this question as well, because this is the million-dollar question that always, how do you time this? How do you find them? How do you get in there, at the right time?
Yeah, so from that point of view, what we try to do with our process is ultimately we are looking for these S-curve type situations. So generally when we're looking at companies, we're looking for this S-curve type situation because that's how we find these structural winners. This is a great slide of an area that everybody knows, which is the mobile phone market. And so this is a slide showing the global mobile phone market from 2008 to 2018. And so what you can see is mobile phones went from 1.6 billion phones in 2008 to 1.7 billion phones in 2018. So phones didn't grow. The economy doesn't grow, and it's unlikely to grow in the future. But smartphones, as I'm showing here on slide 11, go from a 10% market share here to a 70% market share here. So this is the structural S-curve that you follow. Apple was 100 billion in market cap here. It's nearly 2 trillion in market cap here. And so the beauty of these opportunities is they happen no matter what. They happen if Europe goes broke, or if Donald Trump gets elected, or Trump doesn't get elected. The reality is the phones keep happening. The structural change continues. And so our job is to find these things near the start. The ones we're looking at the moment, if I just skip forward, just to show you a good example, is so for the last few years, the S-curves we've been tracking are actually these ones that are more near the start. And so the big S-curves we've been tracking are things like e-commerce, where you've effectively gone from 0% of retail sales to 20% of retail sales in the last 20 years. Or you thought, as I said earlier, digital payments has gone from 35% of all payments in the US to 60% of payments, or digital advertising, or even cloud computing. And so what you can see here on the right are a number of companies that are basically exposed to this, and all of those are roughly in the fund today. The only other thing we'd say about these areas that we've been following for a long period of time, while many of them are well known, then many of them are not even halfway through yet. So the structural tailwinds that we're looking for here should continue for some time. And the last thing we'd say about these areas is they've all been accelerated by COVID. So COVID has actually accelerated a lot of these trends. And so what that does is it makes these companies maybe look a little bit expensive today, but what they're actually doing is pulling forward demand from the future. And they're pulling forward demand from the future that's actually embedding in the value of that company. And so what a lot of people struggle with at the moment is, even though COVID is this terrible thing that's happened to the world and the pie's got smaller, the reality is e-commerce's share of the pie's got dramatically bigger. And so Amazon shares got bigger as well, which is why their share price is higher and why we think it could continue to go higher. Yeah.
So we've touched on the ones that you found. What about the next one?
Yeah, so the next areas that we really like at the moment in terms of this S-curve analysis is really to look at things like biologics, so healthcare drugs. So we know that COVID is going to be a challenge for the world to solve in terms of diagnostics and testing. We also know we have to build a vaccine for roughly 7 billion people that they may have to take every year or even with a booster. So here we've really tried to find the weapons manufacturers in the war against COVID. So these are the companies that build diagnostic tests like Thermo Fisher, or people who build the vaccine like Danaher, and then also people who help make these more advanced drugs in the longer term. So that's one area that we're very focused on. That's actually the biggest area in the fund today. And the last area that we're super focused on in terms of an S-curve opportunity, which is here on the right of slide 13, is really the shift to decarbonize the planet. So the other consequence of COVID is we've seemed to have had this big life-changing event, and now people are worried about the next one. And so the momentum behind decarbonisation is very strong. We're really very much at the start here. So the entire world needs to move to renewable energy. And it's important to stress that while this isn't getting a lot of attention in Australia, there are countries in the world that are going for net zero carbon targets by 2050. And when they say net zero, it's not emit less carbon, it's emit no carbon. And so this is actually going to be the biggest opportunity for the next 20 years. And so we think, obviously Tesla's one winner here, but we think there's a whole bunch of other ones that are going to come along in the months and years ahead.
Totally. And this next slide here, Moore's Law, do you want to break that one down for us?
Yeah, thanks, Anastasia. So the next slide I'm showing you here is on slide 14. And so a lot of people say to us, why do you need a growth investor in your portfolio? What's the why have a growth investor? And so it goes back to what I said at the start, is that your job as your growth investor is to find the big structural changes in the world and find the winners of that structural change. It's the very first line on our website. And so we happen to be living through the technology revolution, okay? So other people live through the oil and gas revolution, or the transport revolution, or the retail revolution. We're living through the technology revolution. I think everyone's got to get used to it. The fact that we're watching this webinar is proof of that fact. Moore's Law is what's driving it. So every computer in the world gets double as speed faster every 2 years. And as computers get faster, disruption accelerates. So all we're showing you here is that, if the first CPUs in 1970 had 2,000 transistors and you double the transistor density every 2 years, today we have the NVIDIA A100 that has 54 billion transistors on it. So this acceleration of compute power on the right is accelerating disruption. So if you think about the internet, it used to be able to just send an email, and then it could just do search, and then that creates $1 trillion in value in Google. And then it can get on your phone, that creates another $2 trillion in Apple. And then it can send pictures, it creates Facebook. And then it can do e-commerce, then it can do payments, and then it can do video. And so the reason why, and then video creates Netflix. And so we're now on the far right of this slide where you and I are benefiting from the software side of it. So the internet has got so fast because of Moore's Law that we can now do a video streaming, which has basically transformed our lives through this COVID period. And so all of this value is being created really by this acceleration of compute power. And the last thing we'd say about this is we know that Moore's Law continues for at least another 10 years. So we know that disruption accelerates, and that's why we think most investors need to have a growth investor in their portfolio, because there's clearly going to be more and more opportunities to come.
Well, yeah, I'm glad the world's moved on from MS-DOS. It'd be pretty bad if it was still there.
Correct. Yeah. Correct.
So this growth argument, obviously, it leads to shareholder growth. if you're looking for companies that are growing over the long term, it leads to shareholder growth. Out of the companies that, you know, we may have touched on today, who is the most shareholder friendly? Well, let's go to the S&P 500.
Yeah, okay. So from our point of view, we would argue that shareholder friendly is investing in your business. And so yes, on this next slide, we use the examples. So we simply take that Moore's Law question, and we say, who's actually a shareholder friendly company? Is it a company that pays you a big dividend? Or is it a company that invests in their business for the future? And we think it's definitely the latter, because if we know disruption's accelerating, then companies need to spend aggressively to win. And what we're showing you here on the left is these are the top 5 R&D spenders in the last 5 years. And this is their sales growth. And so they're using this network effect that I'm showing in the middle here to drive their businesses. And on the right, here's your top 5 buyback investors over the last few years. And this is their sales growth. And so Apple is obviously the outlier, but in many cases, you see banks in particular, not just here in Australia, but overseas, and you also see it in other companies whereby by being so-called shareholder friendly, they're ultimately opening themselves up to disruption. And so the most shareholder friendly companies are the ones that grow. And the way to grow is to spend some money. And you just got to get your head around that when you're looking for great investments. And that's what we try to do here.
Yeah, like the older days, you got to spend a little money to make a little money, hey?
Yeah, and so the last thing we'd say about this is probably on the next slide. It's just worth flagging is this is what a lot of people seem to miss when they're looking at companies. And obviously a lot of the viewers would be looking at the same effect happening in Australia right now. But if you know there's only going to be a few winners and you know that they have to spend money to make money, then ultimately a short-term multiple is not going to help you find a long-term winning stock. You're going to have to do your homework. You're going to have to take a slightly longer-term view. And so this is just a simple analysis that we did where we said, what if we went back over the last 13 years, so the peak of the market in 2007 to the peak of the market in 2020, how many companies actually went up 10 times in value in the US S&P 500? Not from the bottom of the market to the top. That's what the value investors do. From the top to the top, that's what we do. And it ends up being 66 companies. And 66 companies out of 500. And so if you compare those 66 companies on this chart on slide 16 versus the market, you know, more than 50% of them have sales growth of over 20%. In fact, more than 80% have sales growth of over 10%. And then on the right-hand side, you'll see in most instances, you're going to have to pay more than 50 times earnings for them. And in many cases, over 20 times earnings. So you just simply have to find these great winners, you have to take a longer term view. The market is the mediocre many, as you can see on this slide. The select few are the ones that grow. And that's our job for you as your global growth investor.
Yeah. And I think a lot of people do fall into that trap. They see something as expensive and they shy away from it. I put my hand up there when I was a stock market analyst. I was back in 2014. I was waiting for CSL to pull back at $75, whatever it was.
Yeah, and the real key there is, I mean, I'm not saying valuation isn't important. What we're saying is it often stops you doing the work that you otherwise should be doing to find those very few great companies, which is what you're trying to do.
Yeah. So in terms of your portfolio, and do you want to take us through maybe from your thematic-based positioning?
Yeah, so this is a slide that for anyone who's watching who wants to keep up with us, that we update on our monthlies, and it's on the website every month. And it just shows, so if our job is to find these areas of structural growth, these are the areas of structural growth that we're focused on. They are structural areas of growth. We call them our areas of interest. They make up the weight of the fund at the bottom, which is roughly 17%, and the number of holdings. And so you can see integrated health, as I said earlier, is our biggest area. 5 companies, Thermo Fisher is the biggest. Second big area of structural growth is digital enterprise, which is cloud computing. So that's Microsoft and things like Atlassian and Adobe and ServiceNow. E-commerce, I think we discussed earlier, is fairly obvious. Digital fulfillment payments we discussed earlier. It's again fairly obvious. High performance computing is semiconductor companies, so people that help build the cloud or help build the infrastructure. It's the same with connectivity, which is really how you connect to the internet. A lot of 5G plays in there. And lastly, down the bottom is climate, which is an area that we're building up. And so in all of these areas, we see strong structural growth in the years ahead. Hopefully that equals strong structural earnings growth for the companies we invest in. Out of these, some of them are going to be wrong, but the ones we get right are going to be enough to offset the mistakes we make and ultimately lead us towards our goal, which is that double-digit returns per annum through the cycle.
And that's portfolio management. You can't pick them all, but
correct.
Pick a good majority of them. That's good. It's a good outcome. So, Nick, the last couple of slides we have are about the exposure and the performance of the fund. Would you like to take us through those?
Yeah, thank you. So the next slide is just showing so I just showed it by area of interest, and the next slide just shows you by country and by region. And this is something we update now monthly quite regularly. And then the second last slide is really the performance of the fund since inception. So here you can see that 16.9% per annum return. We're generally trying to do that with a lower beta than the market because we haven't discussed this much today, but the fund does have downside protection tools. And then lastly, most importantly, the index or the stock that is quoted today on the ASX is MAET, and it is tracking this existing fund. So it is tracking the Munro Global Growth Fund that has been around for 4 years. And so lastly and most importantly, if you believe that global growth, there are going to be great global growth companies in the world and you are looking for someone who can go find them, then that's effectively our job. The fund has a long track record. It's now quoted on the exchange, which allows you to invest directly in the fund. So we're excited to have made this development in our track record, and hopefully we can continue to create these returns into the future.
Nick, thank you so much for a great presentation, and no matter anyone's financial literacy or understanding, it's something we can all relate to and understand in our everyday lives. You presented us companies today that we all know and are familiar with. Thank you so much.
Thanks very much, Anastasia.
So as Nick said, for more information about the Munro Partners Global Growth Fund, you can head to the ASX website under ticker MAET or directly to the Munro Partners website.